Mr. Sanderson.
G'day, Board. I apologise for not getting here last year.
We missed you.
I'm sure you did. You weren't even here. I've got a question that relates to the clarification of the financial report, and it goes to the heart of cost of living, profit gouging, honesty and lending. I did put this question to Alexis 2 years ago, but she went into the fog of banking and really didn't get to the question I was asking. But when AMP, an Authorised Deposit-taking Institution, otherwise known as ADI, creates a loan, it simultaneously creates a matching deposits through an accounting entry, essentially from nothing, via keystrokes. This process does not require a real depositor or external funds. Aside from capital adequacy requirements as enforced by APRA and the operational costs, there are no direct funding costs at this point of loan origination. When a borrower draws down the loan, for example, to purchase a home, the lender may incur short-term settlement obligations, typically influenced by the RBA cash rate. However, once payment is settled, for example, via the exchange settlement account, the transaction concludes with the bank holding a loan, an interest-earning asset, and a loan-linked deposit, a liability. At this point, the core transaction is complete. Any subsequent actions are such as raising funds through wholesale markets or securitisation are optional funding strategies, not a requirement of the initial loan creation. Therefore, the specific loan's initial funding cost is zero. No external deposits or wholesale borrowings have been raised to fund the loan. The loan has not been securitised at this point. Despite this, the ADIs routinely adjust variable mortgage rates in line with movements with the RBA cash rate throughout the life of the loan. This creates a pricing illusion that loan interest rates must rise due to a cost pressure that did not exist at inception and may never exist in practice. My questions are, where are these loan-linked deposits represented in the AMP balance sheet? Can the board explain why interest rates on loans funded by deposits created by an ADI itself are increased in line with cash rate movements? Shouldn't pricing reflect actual input costs rather than opportunistic alignment with benchmark rates that do not apply to the original transaction? And is it fair, appropriate, transparent or honest to cite funding cost pressures as the justification to raise rates when there is no existing primary act of a loan origination? I apologise for the length of the question, but
No, that's fine, and I understand that there's really two questions there. One is, how does the balance sheet management work? And the second one is, why are home loan rates tied to the cash rate when there really isn't a correlation between those two things, both on a yield curve basis but also...
The transaction?
Pardon?
Talking about the primary transaction,
yeah,
or it's securitised before you go to the market.
So that's a balance sheet management issue, right? So if you think about banks, banks have two key things that they need to do in respect to the question that you've asked. The first is most loans, and let's just talk about home loans because you've been talking about securitisation, etc. So most home loans are 25 or 30 years. There is no such thing as a 25-year or 30-year term deposit. So banks, one of the main functions that banks perform in the economy is something called maturity transformation, where they take the maturity of a short-term deposit, and the term deposit market in Australia, essentially the majority of it falls into 12 months and below, take those deposits and fund 35-year, 30-year loans. So let me finish. And so it's very clear that at inception there is no link between an individual deposit and a loan because there can't be. They aren't for the same term. And so this comes to the concept of banks managing a pool of funds. They have funds from capital, they have funds from money markets, they have funds from bond issues, they have funds from retail depositors. All those funds come together, and on the other side we've got all these assets that come together. And there isn't a one-for-one relationship between any deposit and any loan because there can't be. They aren't on the same terms. So that I think answers your first question.
It doesn't. You've gone past the original transaction. You've gone into money markets and you've gone to securitisation. I'm asking you, when you originally create the loan, you create the deposit, you create the loan.
No.
You have to hold a certain amount of security, approximately 10%, as designated by APRA. Now, what you do past that is what you're talking about.
Yeah, so there is no link up front. There's between any particular deposit and any particular loan. Now, let me go to the second question, which talks about why are home loan rates tied to the cash rate? And should they be? Clearly the answer is they shouldn't be, because not every loan is overnight. As I said, they're 25, 30-year maturities. However, what happened in the 1990s is something called securitisation came along. And John Simon, to his eternal credit, managed to put a product into the market that relied on securitisation. Now, in that instance, there is a direct link between the funding and the loan. And so most of that funding in securitisation is off the back of 30, 60 or 90-day bonds. And they repriced every 30, 60 or 90 days. So he had a direct correlation essentially between the cash rate, ignoring the overnight to 30 days and the cash to bills associated with that, and started pricing based on that. Now, at that point in time, rates were falling. And so he was able to put loans out there at a much cheaper rate, whereas all the banks were still operating off the full model. To compete, overnight, David Murray cut the margin on home loans in half because in a falling rate environment, he had to do that to remain competitive. That then resulted in everybody starting to price it the same way that securitisation prices and repricing overnight. Now, during the global financial crisis, this became a real issue. And ANZ, to their credit, tried to break away from overnight repricing and price off the appropriate cost of funds relative to their balance sheet. They got crucified. So it all went back to where it is. It's an accident of history. It sets up difficulties for banks in terms of being able to manage that cash to bill spread, especially when they have to think about the different maturity profile that they have over their deposit and liability base, but it is what it is.
With respect, I think you've gone past my original question, but we'll leave it at that. I just have a quick follow-up. When AMP securitises a loan, is it not the case that the primary responsibility is transferred to the purchaser of the security and away from the customer? So what I'm saying there is you go out, a customer borrows money from you, That's what they have to do. You securitise that loan. If there's push comes to shove and you have to choose between the purchaser of the security and the borrower, where are your allegiance?
No, well, it just comes down to whether or not the loan's current, right? So it doesn't matter if it's on the balance sheet or if it's off the balance sheet. The fact is that AMP's servicing that loan, managing that loan, and if that loan falls into arrears and requires action, well, AMP have to undertake that, and that's all in the contract between the borrower and the lender.
Okay, I've got another question, but it's a long.
Yeah, well, we might move on.
Where we go.